the traditional and custodians of the land on which we meet, and pay my respects to elders past and present, wherever they may be, wherever you may be across New South Wales. We note that this is, of course, Aboriginal land that we walk on, that we're meeting on today, and that it always was and always will be Aboriginal land. And that this context is incredibly important to the work that we're talking about today in terms of partnering together, acknowledging power, acknowledging relationships, and working together to get great outcomes. I'd like to advise you that this webinar is being recorded, and the recording began at the beginning of the acknowledgement to country. My name's Karen Bevan. I'm one of your presenters today. There's a small bio about me on the slide. I'm working as a consultant, but I'm partnering here with Homelessness New South Wales to bring you some reflections and tips and tricks around how to do great partnering for success and incredible outcomes. I'd also like to acknowledge our second presenter. We've brought in Anna Collett from Purpose Accounting, who brings an enormous amount of capacity and experience in working with not-for-profits around managing and being strategic around finances. So Anna will join us in the middle of the webinar. And I'm so looking forward to hearing her perspectives. And I know that for many not-for-profit organisations, the expertise of highly qualified finance advice is really something that is hard to get. So we're really delighted to welcome Anna to join us today. Just a quick note from Anna and I. We are trying to cover some quite complex questions at a very high level today. And so we might not give you all the detail you're looking for, but don't worry, because we will be following up our webinar today with some resources that will be developed for Homelessness New South Wales. However, I'd like to, really acknowledge that we aren't providing you with legal or financial advice today, and we really encourage you to reach out to any of the sources that you can find for legal and financial advice. There are sources that are free and sources, of course, that you will pay. Because being really well prepared and getting great advice is one of the key things that can help you avoid drama and some of the pitfalls of partnering together. So while we're really looking forward to highlighting areas that you might like to explore as you go through this process, we really encourage you to think about your situation and how these issues can be addressed for you and your organisation. So let us begin. Our agenda today has several parts. We'll start with some high-level information about partnering for growth. And I'll look at some of the basics, some of the things that we need to consider. We'll look at agreements and what sorts of agreements fit best for what types of projects. We'll look at some of the big picture issues as well as a little bit of detail. Then we'll have a look at we'll take a first run at due diligence and what that means, how that works in relation to governance, and what risk assessment looks like in that space. Then we'll move to Anna, who'll do a session for us around how you assess your financial capacity and project readiness. And then Anna will take us through a kind of high-level approach to financial due diligence, some of the things that you need to consider and how you might go about doing that. At the end, I'll come back to you and we'll bring it all together. So we'll look at sort of rounding up the areas that we've talked about. After that, we'll take some, for those of you who are attending the live webinar, there will be a Q&A session which will not be recorded. So let's jump in. Let's begin. So we'll talk today about the key elements for partnering success and really think about how do you prepare, get yourself ready to both approach others to work together or also to respond when people come to you. So we'll look at what you need to think about from your perspective as an organisation, but also the sorts of questions and thinking that you should be doing about potential partners. We're going to cover things like consortiums, memorandums of understanding, types of agreement, but we're going to start right at the top, the big picture view. So partnering when you're in the not-for-profit sector is usually about trying to grow your reach, grow capacity, work better together, link people up, reduce system overlap. It might be about responding to a tender, but essentially it usually allows us to work with others in a more structured way. Most of us already work together with other organisations through interagencies, through shared referrals. We all, work together as a sector to try and increase the ability of our sector to respond to the needs of our clients. So already we do this work, but when we start to move into partnerships that might, for example, relate to building a consortium model that goes into a tender to provide services, or when we're working in a one-on-one relationship with another organisation where we might be agreeing to do certain types of things to work together to get an outcome, there is a need to think at a more structured approach. But the most important thing really is to start off with thinking about who you are and what you stand for. So essentially, there's a great sort of cliche out there that if you don't know what you stand for, you could stand for anything or you'd be open to anything. So this is where, as an organisation, really understanding what drives you. What are your values? What's your purpose? What is your strategic plan focus for the next couple of years? What are the things that your organisation has identified are critical to delivering on your mission? So knowing who you stand for, who you are and what you stand for makes you able to partner. If you're feeling like your organisation's in a period where you just don't know where you're going, perhaps you've lost some recent funding and you're quickly scrambling to try and get some new services in there, that's a time where it can be risky to be jumping into partnerships. So what we'd encourage you to do is to think about, are we ready to partner? Do we know what we're trying to achieve? Now, this doesn't mean that you might not actually make some changes in direction or respond to the climate around you by saying, okay, well, actually, our focus is on, for example, maybe supporting children to have safe environments. That's where we are currently. But actually, over time, we're moving towards building a broader community focus to think about creating a safe community. And that might mean that we broaden out our service delivery. That kind of change is really, always on the table for organisations. But I really encourage you to think about, why are you going there? Do you know what you're trying to achieve? And do you know who it is that you feel accountable to in your community? Equally, when you're looking at working with other organisations, understanding who they are and what they stand for is absolutely as important, because it will be on your values that you make decisions and that you conduct, and that will drive the way you conduct yourself in a relationship. So always look for, and some of the things we might look for in understanding a proposed partner and what they stand for would be, what is their vision and purpose? Have they documented that? What are the alliances that they currently have in place? So, for example, are they currently involved in large project delivery with other organisations? What does that look like? What you might like to ask them, what's your goal in this relationship? Where do you want to get to? What's driving you? Who are the people that you want to create change for and with? So really thinking about that, and then coming back to say, do our purposes align? Do we actually want to get to the same place? Are there any issues with the way we go about things? So often that can be, for example, an issue when we're partnering with, say, an organisation that might be a for-profit provider. We would want to be asking some questions around, well, how do our purposes align? Or if, for example, we're in a consortium with a large number of organisations, is there anyone in there whose purpose is actually not aligned or actually, undermines what you're committed to? Doing that work up front means that the relationships you get into are the relationships that actually allow you to live your values. They won't always be perfect. Nobody behaves perfectly in any of these scenarios, but there is an important piece of reflection that it's actually your responsibility to do right at the beginning. Who am I? What is this organisation about? Will this relationship actually help us live out our purpose? Recently, we've seen some fallout from this kind of assessment in some of our large grant programs, where organisations are actually saying, we started this partnership or this relationship because we thought this grant program was going to deliver on our aims, but we realise that actually our purpose is broader than this, or this contract or relationship is no longer serving the change we want to make with the people that we serve. And so the process of undoing partnerships can happen. And certainly there's a little bit of that happening around in our sector. I see that as a good thing. And I encourage you to, see your kind of careful assessment of where you're at in the partnership, not as a crisis, but as an opportunity to always focus on your purpose, your values, and what change you want to make in an organisation. The other thing you need to think about in aligning your purpose and values is who and what else comes with the relationship that you're starting. So, for example, are you partnering in a consortium, as I said earlier? Is that bringing you a whole bunch of new organisations that you may or may not be really well across? Are there kind of ways of working that are coming along with this partnership? So, for example, are there requirements around the data that you collect that you need to be aware of? Are there requirements to work in a particular way or to deliver services in a manualized format? So, for example, some of the manualized formats that we might come across could be something like a home builders model, or multi-systemic therapy model are two that come to mind, where you actually are required to take a model off the shelf and deliver it in accordance with the manual. If that's what comes with this relationship, then you need to be really aware of that. Does that fit for you? Can your staff deliver that? Do you feel committed to that model? If not, where are the opportunities to have conversations about how you deliver it? So really thinking about that. Some other areas that you might want to think about are what sort of benefits the partnership might bring to your organisation. So, for example, does this partnership allow you to expand into an area that you've been keen to work in? Or does this partnership bring you access to resources that you need in order to expand your services or deliver well? Can you do some agreements around use of office space? Can you share costs? So there's, often significant benefits that come from these partnerships. Some of the challenges might be, are you co-locating with a new partner? Do you and your team know what that means? Have you worked that out? What are some of the challenges that might be inherent in that? And then what are some of the risks? So some things to think about around that might be, what are the reputational risks? So by reputational risks, it might be, for example, by association, you're linked to an organisation, where that organisation does things that are broader than the project you're working on, but actually, say, put them in the media or highlight their work in your community. Are those kinds of those statements, or the way that organisation operates in the broader community, are they in line with your values, or are you comfortable with that? And knowing, of course, like, all organisations, none of us are perfect, and sometimes things happen in our world that we don't anticipate. Being really clear on what are the values that you will use to make decisions around whether the risks outweigh the benefits in that kind of situation? Or how will you communicate about that? What are the relationships and agreements that you need to have in place? So, to kick us off, we really need to go big picture, know thyself and know others. Do your business, do your due diligence, and we'll talk about what that means. But, try to find out, what is doing business with this partner really like? And does it sort of sit well with who you are as an organisation and what your mission is? So when it comes to partnering, once you know yourself, then you're really looking around. Now, you might be approached by someone or by another organisation or several organisations to join a relationship around a consortium or a funding, a more simple partnering to, achieve funding, or you might be approached to deliver services under a subcontract. You might be approached, or you might approach others. So some of the sort of high level things that we need to think about are, who do we partner with? We've talked about values and purpose. That really lands too around, what's the strategy? What are you trying to achieve? What are they trying to achieve? Being really clear on what capacity you have and what capacity they bring. So really thinking about who will best align with you, or who will connect well to build, maybe add to your capacity, or to do some things that you're not able to do that still allow you to stay in an area. So that might be, for example, if you are, say, a provider of counselling services, but you're really looking for, a connection with a service that can access accommodation or access specific mental health services. So you'd be looking for an organisation that complements your services. Otherwise, you would say, well, maybe we can do this ourselves. So it's really about, do you have the capacity? Do you want to build the capacity? If you don't, who does have the capacity to do the work? So really looking to identify that. Some other things you want to think about is, what is their capability? So when you look at understanding what capability you have, so what are the staffing resources you have? What are your financial resources? What kind of land or other pieces of resourcing that you bring into the contract, and can you do it well? So capability really helps us think about, what is it that we can do well? Like what's in our kind of, what's in our area of expertise, and what might someone else do well that we can't? So that's where the difference between capacity and capability is. Can we do it? Maybe. Do we do it well? Question mark. So looking for partners that maybe bring capability that we can't build ourselves. I guess that's really thinks about the idea of fit. How do we fit together? And actually doing the work to understand where those relationships will fit. We really want to partner with people who add value to our services. And when I think about adding value, it's about maybe delivering something that we can't do for our community or the people we serve. It might be about adding some, capacity to our consortium. It might be about bringing to our staff some new skills. So we really want to be partnering in a way that adds value to what we do, not just kind of allows us to have access to funding. And while I really acknowledge that, is super important, we're all looking to make sure that our services are well resourced. Funding in and of itself will not be enough if we can't build our partnerships and relationships well. So I wanted to talk about, in this context, power. Power is a really critical part of partnering and understanding how partnering will work. One of the things that we've seen often in the sector, where we've seen opportunities through large tenders that come through, or restructures of sector service delivery, is that we often see different types of organisations come together. We've seen some amazing examples of organisations that have been able to come together for the good of both and really deliver. We've also seen experiences where things don't go so well. And often power is one of the areas that can really undermine the effectiveness of a partnership. So I don't think power is inherently good or bad. It's really about how it's used. Can it be leveraged with good outcomes? And in particular, and I speak to our sector quite specifically in saying we have lots of variety around size, access to resourcing in our organisations. So we have some very large organisations who, as a result of their size, have scale. So they can actually, do more at that level of, say, financial management. They might be able to resource additional staff or additional functions, for example, around quality assurance, advocacy, around people and culture. So we have some really large players. We have lots of kind of medium to large, lots of medium and lots of small, and lots of really small organisations. So across our spectrum, we have a lot of different size and scope of organisations. And into any relationship, there are different power differentials. So I think when it comes to power, it's critical to acknowledge that there are power dynamics and to seek to understand those. Really, we want to be having open conversations about anything that makes you uncomfortable in the way that power works in this partnership. We want to match agreements that reflect some of the power dynamics. Who's going to take responsibility, who has more access to resources, who takes, for example, for responsibility for overall reporting based on who's got more resources to do that well. So having some conversations about power. I mean, some of the examples I can give might be around things like acknowledging that some organisations have a significant heritage and legacy from their heritage. So, for example, some church-based or or social service organisations that have been built over a long period of time, and have relationships with churches, may actually bring to a partnership some of the legacy of that, which might be access to a wide range of volunteers, might be access to property or a history of connection to church organisations that have been able to raise funds. They may have access to, local services that can connect with your partnership. So understanding that when someone brings that can feel like they bring power. However, it's always important to know that whether or not you bring that legacy, you might bring something that is absolutely critical. A smaller organisation might bring something that's absolutely critical to the delivery of the service. And so we see that power has many elements, but to deny it exists is to set your partnership up or your consortium up for failure. Because when the rubber hits the road and you start to, say, for example, hit deliverables on a project, and one partner may not have the resources to really ramp up delivery. So, for example, often contracts have very unrealistic requirements that you basically ramp up a new service within 3 months, and that you be 100% providing within 12 weeks of signing a contract. Now, a small organisation that doesn't have, say, a large staffing pool to draw from may not actually be able to ramp up delivery that quickly. A larger organisation with a range of, staff that might be able to be pulled across into a program may be able to deliver that more quickly. Now, if, for example, there is a conflict around deliverables at the point of ramp up, if you haven't talked about those issues and the power inherent in some organisations and their legacy, then you're likely to have if you haven't had one already, you're likely to kind of hit your first speed bump. So I really encourage you to have those conversations. What does it mean in our relationship that you're a large provider with 70 outlets across the state, and we're a small community-based service that has a very high level of expertise in a particular group, in working with a particular group of people? What does that mean when it comes to ramping up? What does that mean when it comes to trying to recruit staff if we're both recruiting into the same pool at the same time? How are we going to manage that? Like, having those conversations up front. I'd also really like to acknowledge and that Aboriginal community controlled organisations are often involved in consortiums or may work with other organisations on projects. And I think that there's some inherent power issues there that need to be spoken about, and they need to be dealt with up front. For example, let's acknowledge that Aboriginal community controlled organisations are generally newer in their development, may not have the legacy of many decades of fundraising, and may not have access to some of the land and other types of resourcing that comes with legacy and long-term establishment. That shouldn't mean that those organisations are less powerful. And in fact, I think we'll find that increasingly contracting will require us to enable Aboriginal community controlled organisations to take leadership in consortia. But we need to talk about that up front. And I think, we've talked a lot in our sector about the importance of building capacity in working with Aboriginal community controlled organisations. But if we don't talk about power and how that impacts and the kinds of expectations that some organisations are managing while others aren't, then we're really doomed to not getting this right. So I really encourage you to think about that. So some of the key questions that I encourage people to think about are we really partners? So think hard about, is this a partnership, or are we just subcontractors for delivering services, which is a really different conversation. Are we able and can we address power imbalance? And how do we then use the right type of agreement to reflect our relationship and to address some of those power dynamics? So really encouraging organisations to be quite specific about having a conversation about power differentials, but also to remember that size is not always power. When it comes to working in communities where trust is key, organisations that are local, speak to people about where they're at, have the trust of their local community, hold a type of power that simply having a scale doesn't bring. So, there are all types of power in these relationships, and we need to acknowledge that. So really, when it comes to setting up for success, some of the most important points that we've learned in previous partnerships are really important. One, know your values and understand your bottom lines. So a bottom line really becomes the thing that the line you won't cross. So for example, at what point, if you're being asked to do more with less, what is the quality point at which you will not budge? So that could be a caseload analysis. We require that we have a caseload of X. And if the grant or if the partnership puts us in a situation where we need to undermine our own agreements about quality and caseload, that's our bottom line. You need to know that before you go into partnerships, or at least if that changes, communicate that well. You want to partner with people that really add value to you and your community. The only reason we really want to, the reason we're here is for our communities and the people we serve. If a relationship helps us do better in that work, fantastic. If there's not a really good basis, then, you know, you have to think twice about whether this is the right relationship. Be clear up front about your expectations. What does it mean to be a partner for you? What do you want out of the relationship? Be really specific about that. So we want to start to unpack the expectations that sit under our agreements. Be clear about roles and responsibilities. List them out to the best of your ability. One of the big learnings, I think, from some of the major tendering and partnership and consortia building work that we've done recently is that we need the right type of agreements that reflect the type of relationship, the financial scope, and the risk associated with a project. I'm going to go through different types of agreements and matching agreement to what you're looking for in a moment, but proportionate agreements. I'll give an example of this. So I once ran an organisation and we went into a partnership with a much larger organisation. What we brought to the table was money, capacity to deliver, and a relationship with a philanthropic organisation. What the larger organisation brought to the party was the people that we were working with. So the access to the client group that we were specifically trying to deliver for. Now, so we brought quite a lot into that room, including the money and all of the delivery, but without them, we couldn't deliver the program. What happened there was a really interesting one where they came with a really highly legalistic memorandum of understanding or a partnership agreement. We did not. And I must say at the time, I really struggled with the sense that as they were really the junior partner in this relationship, but I was signing their very legalistic agreement. And I think that's something to think about. Like, how does the agreement meet the scope of the work you're doing? Does it address some of those power issues? And if not, how do you have a conversation about getting the agreements right? Really, what we've learned, and some organisations have learned the hard way, is that if you can get legal advice on contracting and consortium arrangements early, you can save yourself some heartbreak in the long term. So strongly encourage that. It's a good investment of resources. Be upfront about power asymmetry. So if there are imbalances of power, be upfront about it and think about how it will be managed. Two important things that I think our sector has learned the hard way. One is upfront, we need to talk about how agreement or contract breaches will be managed. Often we just want to believe that we're all going to do the right thing, and often we all do the right thing and things still don't go according to plan. So talk about how they're going to be managed upfront. And also, you need to think about the world can change, particularly some of these longer term funding arrangements, 3 years, 5 years, organisations, communities, all sorts of things can change. It's important to have good ideas about how someone can end their role in a partnership or consortium, or how a consortium can act to remove a partner. So we want to do that at the beginning of negotiations. And they're often the hard conversations to have, but it's important, A, that your agreement includes it, and B, that you've actually talked about what that means. So we're going to now look at the kind of more detailed focus of partnering well. So we've talked a lot already about getting the right partners. We want to talk about getting the right types of agreements, and we want to talk about getting the right arrangements. So really getting the right arrangements really sits around why you're partnering and when. So we've focused a bit on that already, but I wanted to think about the opportunities, the reasons we're usually moving to work together. And in this conversation, we're also going to start to talk a little bit about other types of arrangements that might include mergers and amalgamations. Please don't panic. I'm not here to tell everyone that's what they need to do, but sometimes our partnering arrangements might take us in that direction. So it's important to have our antennae attuned to some of those types of arrangements as well. So we normally start to look at partnering with others when there are opportunities. So, you know, when there's a major retendering of a contract that's going out. So it might be, you know, in the context of a whole new government policy or a whole new service stream that's being developed. You know, what are some of those opportunities? It might be a philanthropic funding opportunity. It could be the opportunity just to work together because we find ourselves, you know, co-located and we start to see some synergies. So thinking about, like, what are the opportunities that might arise, and then, you know, how do we actually respond? Some of the other ways that we might want to think about partnering is where we can address gaps that we're noticing in our service delivery, or where systems are, you know, like overloading or overlapping, and there's an opportunity for us to take some leadership around actually providing better, more streamlined responses or multidisciplinary responses. You know, sometimes we actually want to partner just because we see that together we could work really well and more strongly. Sometimes we want to increase our scale and impact. And that's really a great reason to partner. When we know what we're trying to achieve, when we understand what our impact is, we're trying to, you know, work hard to increase that. So some of the ways that we might do this. Now, sometimes we do this in a really informal way. We might not have an agreement, but we might start to, for example, you know, catch up together more informally. We might create a new interagency or a new forum meeting. These might be quite loose arrangements. And these are often the ways that we start to work out. You know, we talked about purpose and values and alignment. This is often the way that, you know, the relationships start. So a no agreement is a way that things begin. Sometimes that might move to a memorandum of understanding, and I'm going to talk about that in a little bit of detail in a moment. We might then go with an agreement, you know, and when I say a partner agreement in this context, I'm talking about really where two organisations might make an agreement to work together in a particular way. So it might be a step up from an MOU into a more formalised, legally binding arrangement. It might include information about sharing finances. It might include how staff are going to work together, or you might have staff providing a service at somebody else's location. So that would be a more formal partner agreement. Then we've got consortia. So thinking about a consortium agreement and what that might include. Now, consortia, I'm going to talk more about this in a moment, but consortia usually includes a number of agencies coming together to deliver on a project or funding stream. Now, let's not forget about subcontracts. You can be a subcontractor and still have elements of partnership, but once you're a subcontractor, you are a direct deliverer to a lead agency. So we need to be really clear about whether being a subcontractor is a partnership or is it a one-way business deal. We fund you to do X. You don't do X, subcontract ends. Or we deliver this service for you for an agreed price. If we no longer do that, or you no longer fund us to do that, then the relationship ends. We need to be really clear about how our subcontracts work. And I think that's an area that we've learned a lot about in the last 5 years in our sector, that a subcontract isn't always the same as a partnership. It can be, but we have to do the work around establishing those partnership relationships and setting up some of those broader understandings around, you know, what capacity we're adding, who has power, what that power means, in order to make sure that that subcontract remains a partnership and isn't just a nice, clear business deal. Sometimes a nice, clear business arrangement is a good thing. We know what we've got to do. We know who we're doing it for. We're happy, you know, just to be delivering directly like that. Sometimes that's the most direct way to deliver a service. There are other ways to do it, of course. I'm going to focus on these ones, though, as we go ahead. So memorandums of understanding are what we've often used in our sector. And I think the plural of memorandum is memoranda of understanding. Feels wrong. We often use these because they're often a way to kind of, set up a shared purpose or a shared intent. It's usually a starting point. It's a way to set out some of the preliminary understandings we have about what we want to achieve together. It often outlines, those broader goals, and it really sets up a sort of commitment to act in good faith. So these are really great where you want to say, have good referral processes or cross-referral processes. It might be where you're coming together to advocate for a change. It could be where you want to formalise a really positive relationship. So generally, the two parties or more than two may sign a memorandum of understanding. It has some general agreements, and often we use that in order to enable us to move to a more formal agreement. An MOU is not usually legally binding. It can be, but you need to be really clear about that together, so that either it is or it isn't, but generally these are not legally binding. And often that's because we don't really know. Often we'll sign an MOU at the beginning of a consortia process in order to say, we are all working together towards this, and here's how we're going to do it. Here's the purpose of that. And how this is how we're going to work together. Usually an MOU is not really sufficient for the exchange of financial, a financial arrangement, and it may not be sufficient for the exchange of confidential data, confidential financial information. And that's where it's really good to get some legal advice about, if you think an agreement's, an MOU is legally binding and your partner doesn't, there's a problem there. So we want to really be clear about that. But often, legally compelling or not, people will often comply with an MOU as if it were legally binding, because they're committed to the purpose, and because once we've signed an MOU, we are often talking about that publicly, and it links to our professional relationships and also our reputation. So MOUs are an important part of the spectrum of agreements. At the other end, we've got more of a formal arrangement. A consortium is a more formal arrangement. And what it is generally is the association of two or more individuals, companies, organisations or governance. And sometimes it's a combination of all of the above. And we see those more complex consortia even in our sector, where we might bring in a provider who's an individual, a company, then government might even be in there. And it's really about how do we participate in a common activity or pool resources. So in a consortia, and this is very important, we all have our separate legal status. If as a group we want to actually create a new organisation into which we all come together, that's a very different set of arrangements. It might be the development of a joint venture company or a joint, a new organisation that we create for the purposes of this delivery. So important to understand that when we go into a consortium, we hold our legal status. We are a separate organisation. And our agreements usually are limited to the activities we take as a consortia. Now, that can be interesting when the behaviour or the activities of parties within the consortia actually impact on the delivery of services. So that's a very interesting one, and again, we go back to, let's talk about what happens if we don't all around what a contract breach looks like early, so that we don't end up in trouble there. And usually we have a contract agreement for a consortium that has the rights and obligations of every member. So it's a much more formal. And all the way, there are so many other types of agreements. But some of the considerations we need to put into place when we make agreements is, are we aligned on the project? Do we absolutely understand what the project is? Do we know how long it's going to go for? What are the review points in our agreement? What impact will this have on my organisation? Do we know roles and responsibilities? Can we address power asymmetry through agreements? And if not, how else do we address them? Is the type of agreement proportionate to the project? So what that means is, are we using an MOU for a multi-million-dollar service delivery project? If so, probably not quite the right agreement. It's out of proportion. But so is that heavy-duty legal agreement I talked about earlier for a fairly loose partnership. So we want to make sure it's proportionate, because there's work associated with these types of agreement, and there are responsibilities and legal implications that we really need to be across. And just a last one, and we're going to cover this a bit later when we talk about the role of board and the role of management. We need to be really clear about who can actually sign agreements. I can't tell you how many times I've been on boards or been in leadership roles in organisations where it's been unclear who's actually allowed to enter into the agreement. And also situations where, say, a manager or a coordinator has signed an MOU or some other form of agreement on behalf of an organisation when they're actually not, they don't have the appropriate delegations. So we need to be really clear about that. So just a quick sort of wrap up around, understanding what the agreement needs to achieve and matching. So I've just used a couple of different types of agreements here. You can see that if you really try in an exploratory phase, an MOU is a really great way to go about it. If you're really starting to get, the rubber's hitting the road around service delivery, or you're getting to a point where you're finishing a tender and that you need to share financial information, something more binding and more legally binding is appropriate. Where you're working with an MOU, where there's no finances involved, you might find an MOU is adequate. Otherwise, even without funding involved, you might find that a more formal agreement works for you. So you can see across there that there are points at which certain types of agreements reflect the intent of the work that you're doing. I think where you're wanting certainty, a subcontract is the most direct. We are going to pay you X to do this service. So that allows you to know when to provide, that's a really direct one. A consortium agreement will provide more certainty when you're further down, for example, once funding is approved and financial arrangements are documented and agreed. So there's a range of ways to think about making agreements. So one of the things I'd really encourage you to do is look around and consider some of the things that you need to do. So just quickly, I wanted to mention due diligence, and I'm going to hand over to Anna in a moment. So due diligence as a concept is the process that we use to prepare for going into a relationship or partnership with another organisation. It gives you an opportunity to make an informed decision. And so what I'd encourage you to think about there is that partnerships are not always just agreed. We don't just go into it. We actually need to stop, pause, reflect, do some work to understand what this means for us. So investigating, I put that in inverted commas deliberately, because we're not really, we're not private investigating trying to understand everything that has ever happened in another organisation. But we do need to, build a case for understanding how an organisation works, having some clear data that helps us make decisions about whether this is the right organisation to be involved in. And we may need to go into an agreement or a memorandum of understanding of some kind in order to access that. We might need a more formal agreement if we want people to hand over confidential financial information. The process of reviewing and analysing that information, and sometimes we'll use professionals like lawyers and accountants to help that. And it's really about that assessment of, you know, what is the risk that comes with this relationship? And what are the liabilities that might then start to sit with us? So, and this is where the advice of really, you know, a lawyer, and this particular material has been adapted from Justice Connect in their not-for-profit law area, who have some real expertise around that. So we want to be looking for organisations that can provide us with advice and support in that space. So again, you know, due diligence is something we do when we're looking at other organisations, but it also is quite helpful to think about how you do this for your own organisation. So the amount of due diligence that you do should match the scope of the agreement or the scope of the work that you're going to do together. So if you're going into a multi-million-dollar, multi-year contract with someone, you're going to want to do some pretty serious due diligence. If you're going into an agreement to share referrals, that might be a different type of due diligence. Critically, your board need to be engaged in the due diligence discussion, and they should be actively considering the information and making final decisions. You want to be really clear about the purpose of the activity in order to match the due diligence. And, you know, it might be helpful to think about doing the same amount of due diligence on yourself and your ability to be the right partner in this relationship as it is in looking at other organisations, and think about what resources you need to undertake good analysis. So when we look at due diligence, you can see that the role of the board and the role of management are really important. But clearly, the role of the board is not in the operational exercise of due diligence, unless you're a very small organisation where your board does have some more operational responsibilities. But we want the board, they should be deciding whether an proposed partnership, relationship, contract links to your strategy, because it is the board's job to have a handle and a leadership role in strategy. They should be assessing risk and monitoring risk. They should know and have in place good delegations of authority, so we all know who's allowed to sign, who's allowed to negotiate, and they should have the final decision on any significant partnership arrangements. In terms of management, and that's many of us here today, be exploring options, you'll be researching, you might be identifying partners, you might be looking at options for delivery, linking relationships to strategy. You should be briefing the board, developing the risk management plans, and helping the board around identification of risk. You should be making approvals and signing in line with delegations, and management, of course, is implementing these relationships. So that's the beginning of due diligence. We're going to move to Anna now and looking at assessing financial readiness and managing financial risk. Anna's also going to look at financial due diligence.
Hi, everybody. Hope everybody can share see my screen there. Thanks, Karen. So I'm going to be talking to you today about assessing financial readiness of your organisation to take on new funding and increased funding, and assessing and managing financial risk. So these are the broad areas that we're going to be covering today. I won't, just in the interest of time, I won't read through all of those, that info there on the slides, and I think Karen's covered some of this already as well. So assessing financial capacity and readiness for projects or funding, really we need to look at two quite distinct elements of your organisation when we're looking at financial capacity. The first is your actual finance function itself, so your resourcing and capability in your finance function, so staff in terms of both FTE and skills, technical expertise, experience, and your system resources and processes and the efficiencies of those. And by this, we kind of mean whether your financial systems are designed and in place to cope with increased complexity. So things like adding new funding streams, reporting requirements, etc., and increased volume of transactions and the associated reporting around that. So the latter component there really relates to your process efficiency. So doubling transaction volume, for example, in a manually driven finance function for example, where data entry, invoice approvals, things like that are all manual and paper-based, will mean doubling the time required by your staff. So that's not the case with digitised or automated finance functions that are better able to scale up and cope with an increased volume and an increased complexity of throughput of the finance function. Ensuring your accounting and reporting system can cope with new grants is also really important, and that you can comply with the conditions of the grant. So if you've had instances in the recent past where you have found acquitting funds difficult, if your acquittal and audit processes are a bit of a nightmare, then that's probably a bit of a red flag in terms of increasing scale and really going for growth and adding new projects, that you need to probably have a look at what the nuts and bolts are behind those processes and understand why you've had difficulties there. And so at a minimum, in terms of adding new funding streams, that's going to mean being able to use cost centres if you're not already, to differentiate income and expenditure for each grant and each project, and using accrual accounting processes. As well as being able to easily produce management reports of a good quality on a regular basis. And we'll go a little bit later in this session, we'll go through what that might look like. So if more finance or more other back office resourcing like IT, HR, etc. is required, then that will need to be factored into your project budget or your funding bid somehow, whether directly or indirectly through an overhead charge. The other piece that Karen has touched upon before that is relevant, as well as having a look at your internal controls within your finance function. So Karen touched on things like, ensuring that people are duly authorised to sign contracts. That kind of authorization and those internal controls really span much further into your finance function. So really understanding and making sure you've got good controls in place over who can commit the organisation to expenditure, who can purchase goods and services, up to what limits. So if you are looking at scaling up, those are the kinds of things that you need to have a good handle on. And if you don't have those kinds of things in place, then your exposure to risk of loss through fraud or error really increases. And we'll touch a little bit further on that as well later on. The second part of assessing financial readiness and capacity for new funding is also around looking at your organisation's financial position. So looking at reserves, cash, and stability over time. We'll go a little bit further into some detail on this in the next few slides, but really looking at whether your organisation has a buffer of reserves to deal with any increased risk associated from increased grant funding. How will a new program or increased grant expenditure impact your cash flow? And does management have a clear sense of this before the new grant or partnership is undertaken, and how these measures will be affected by a new grant or program? A CFO should be able to model this for you with a scenario planning exercise or something similar during budgeting. And really lastly, to consider whether these measures of financial position have been stable over recent years. So is there relative predictability in your organisation, or is there volatility? Is it quite highly changeable from year to year? And how accurate your budgets and forecasts have been in the past. Obviously, if you've had some difficulty kind of getting the numbers right or sticking to budgets or forecasts, that's another thing there to kind of analyse or dig a little bit deeper on before you are committed to increased funding. Whether you can rely on your financial figures is another really important question to ask, and what your result is expected to be this year with and without new funding added. So looking at simulations of how that will change your financial position is really important before you go into these kinds of arrangements. So we're going to look at some key measures to assess your organisation's finance position over the next few slides. So one of the ones that we use quite regularly is measuring working capital reserves in weeks or months. So working capital reserves in weeks measures the number of weeks your organisation could operate for if all income was to cease immediately. So it's working capital itself is your organisation's current assets, so sometimes referred to as your liquid or financial assets, minus your current liabilities. And your current liabilities are debts or bills due to be paid within the next 12 months. Expressing working capital as a measure of weeks of expenditure helps us to get a sense of how long operations could continue for if all income was to cease. Not a fun game to play, imagining that scenario. And of course, it rarely happens, but that's also what we thought before COVID came along. And I think, obviously big disruptions like that can catch organisations out. Assessing this measure isn't really about playing out that apocalyptic scenario of what would happen if all your income ceased, although that's a game for a different time, but more to get a baseline sense of how much buffer you have to withstand hard times. And the way that we measure working capital reserves in weeks is by first calculating your working capital, then dividing it by your weekly expenditure. And we'll go through a worked example in a minute. You can express it as months of expenditure too, whatever suits your organisation. So we often get asked what's a healthy range of reserves. And in the NFP sector, we generally consider 3 to 6 months worth of reserves as a healthy range, so a minimum of about 13 weeks. But every organisation is different. It depends on your funding context. So if your funding is quite volatile, not guaranteed from year to year, you might want to hold more than 6 months of worth of reserves just to give yourself that increased buffer. Otherwise, if your income and costs are very steady and reliable, so we know, for example, some fundraising organisations who have a base of income from regular donors, so that's your $30 a month direct debits, that's quite large, quite stable, then they're looking at that healthy, that lower end of the healthy range, or even below that, even looking at 6 to 8 weeks being a comfortable amount of time, knowing that it's very unlikely that all their income would actually cease at once. So it depends on the context of your organisation, but having a discussion about this at a board and at a governance kind of level is always a good exercise to undertake. And many organisations also develop reserves policies too, so that they can maintain that buffer within a comfortable ratio and report on it from month to month as well. So let's get our calculators out. Just joking, but you can play along at home if you like. So just a quick worked example of working capital reserves in weeks. So in this example, the working capital reserves are total current assets of $2 million minus total current liabilities of $1 million gives us working capital of $1 million. If your weekly cash expenses were then $80,000, we would divide $1 million by $80,000 to come up with 12.5 weeks. So in this scenario, they're kind of at that lower end of what we would think is a comfortable range, or just kind of hitting that comfortable range there. So this is a fairly common kind of level of reserves in the sector. So one of the really key things to look at when assessing measures like this is it's important to note whether they've remained relatively constant over time, or improved or worsened. And you can get, multiple years of your financial reports out and actually look at that change over time. So knowing whether it's declining or improving is really important. A worsening reserves positions obviously generally cause for some concern, unless it was strategically driven and deliberate. And we do see this sometimes where organisations have quite high level of reserves that they choose to strategically invest in things and to dwindle down. So trends are everything in financial analysis, and just kind of picking out 1 month worth of this measure isn't all that helpful in and of itself. Developing a cash flow forecast based on your budget is a good additional way to check, to sense check whether you'll have adequate cash reserves over the coming year or years, however long the project will be going for. And overlaying how a new program might affect those cash reserves is also a good idea. And that'll enable you to understand whether funding agreements really need to provide cash upfront, which is always a good idea anyway, or whether you can cope with delays in funding or arrears payments of funding. Calculating a current ratio is another measure that we can do off this, the data that we have here, which is a good rule of thumb on solvency. So solvency is your organisation's abilities to pay its debts as and when they fall due. So the example above to get to a current ratio is current assets divided by current liabilities. So $2 million divided by $1 million. It's an easy one, 2. So it yields a current ratio of 2, and that means for every dollar the organisation owes, it has $2 to pay it. So again, this is a comfortable, healthy range. We generally consider between 1.5, like 1.5, and 2 to be a comfortable range of reserves, and anything outside that is, below that is getting a little bit concerning. But again, the comfortable level for your organisation needs to take a lot of things into account. And again, the change over time is really important as well. So if it's worsening or if it's improving, matters a lot to the analysis. So a little bit on financial due diligence, and Karen's touched before on some of the governance or the risk pieces on this. I'm going to talk a little bit about being able to assess project partners in terms of their financial situation. So funnily enough, much the same as assessing your own organisation's sustainability, which we looked at a couple of these measures just now. But annual audited accounts of charities are available on the ACNC's website. Obviously, annual audited accounts of private companies are not available publicly. So that would be something that you would have to request if you were going through a full legal due diligence process on private company partners, if you're going down that road. But audited accounts for charities available on the ACNC's website, often on their own website too. And some of the key measures that we just discussed will help you to form a view of their financial position as well. Again, look at the change over time. So the ACNC's website has 7 years worth of organisational data there, and have a look at some of the key measures there to look at is their overall turnover or their income. Is it growing? Is it declining? And how changeable is it from year on year? So a positive or negative change of 20% or more of revenue from year on year, we would probably call volatile. And that really can indicate a range of management challenges going on in the organisation. So whether that growth or that decline is planned or not, it does mean that, if you think about the impact of that on their staffing, back office and the general operational challenges that might represent, we need to consider then, could that impact your organisation's project delivery with them as a partner? And these are things to talk about when Karen mentioned before in terms of being quite open about these factors in that initial phase of getting down and talking about going through agreements and things like that. This is all something that you can mention and discuss. So are they reporting net surpluses or net deficits is a crucial point to see there in their accounts. Are their bottom lines broadly stable? And bearing in mind that changes in accounting standards on revenue recognition recently have meant that a lot of grants are getting caught up in that. You may have had experience in your own organisations of auditors doing all kinds of crazy things with grant recognition. So those issues in accounting treatment are often explained in disclosing notes to the accounts, although you're forgiven for not having read those. They make even me snooze as well when I have to go through them. So another important element to look at when, so this is kind of looking at the second bubble here on the screen to assess is how material this funding would be to the partner organisation or the consortium partner. Like how large is the size of their potential share of funding for this organisation compared to the current turnover? And if this proportionality is very high, looking at kind of more than maybe 20–30% of their current turnover, again, there needs to be questions on their internal capability or internal capacity asked in terms of how they would deal with this new amount of funding. And they're the same questions of financial readiness that your own organisation will be asking itself as well. And this financial due diligence is obviously only part of the picture. In terms of other publicly available info, either on ACNC website or other info online, you're often able to ascertain whether the potential partner has handled, and that's meaning successfully acquitted and delivered grants of a similar size. So that might be disclosed in their annual reports. There might be other online info. There potentially could be info on websites of the funder as well about those programs. But it can be hard to glean from their accounts alone. So having received funding from the same departments in the past and recurrently is a really good indication of past delivery. And of course, the sector's quite small that we all work in, and references can and should be obtained as well. So moving on to the next area. So consortia, grant partnerships and subcontracts. So these all have a slightly different risk profile from a financial perspective. And Karen's touched on some of these, so I won't go into some of the detail here in terms of the legal side of things. But, you know, these can take many legal forms. And here it's important to understand the difference of what's being agreed and presented in a different a legal format. So what the substance or the nature of the arrangement is rather than what it's being called. So the terminology can often differ in discussions versus the actual legal structure that's taken up by these. And this is the difference here is what accountants and lawyers often refer to as substance over form. And from a legal perspective, including, you know, financial legal implications, like tax and things like that. Everything will come back to what is the substance of the arrangement, not what you call it. So not the name that you use for it. So the risks and the flows of funding in each option here differ. And it's important to understand those flows of funding in order to understand the risk profile in each. So with a consortium, generally the funds will be dispersed from a funder to a lead in the consortium, and then they'll be dispersed again onto members of the consortium. That's often what happens, not always, but we usually see that in consortia. So the expenditure on dispersed funds will then usually need to be reported back to the lead, who consolidates reporting and acquits back to the original funder. So this lead role really requires more experience, more resourcing and complexity in its financial kind of operations and systems than being a non-lead member. And there's a key question here on who bears overspends, who can retain unspent funds. Will the underspends by some members of the consortium be used to absorb overspends on others? So there's a lot of issues here that need to be agreed at the outset among members, and the frequency and the format of financial reporting and the approach to components like admin, management fees, those kinds of costs really need to be hammered out at the start to avoid potential disagreement or confusion later on. So again, where the actual agreements with the funder and the sub-granting agreements don't capture those kinds of things, ideally they always would. Where they don't capture those kinds of approaches is something that can be collected in or covered in a memorandum of understanding as a secondary document there. So grant partnering with another organisation requires a coordinated approach and clarity from the outset about who's responsible for components of project delivery and how decisions affecting both funded organisations will be made. So will funds be received and acquitted separately directly to the funder, or will they pass through one partner and then go on to the other? Are both partners jointly liable for unders and overs or non-delivery, or do they have discrete funding arrangements and agreements with the funder, thereby limiting their risk to each other? So in terms of subcontracting, as Karen's mentioned before, it's a much more straightforward approach and more commercial in its nature, which throws up different kinds of financial risks. So usually consisting of funding or payment for a specific delivery of an outcome or a service, often milestone based, so quite clear as to when you're entitled to the funding. But key questions to ask here is whether there are penalties for non-delivery or late delivery. So this is often the case that we see in contracts like construction work, where there will be penalties for non-delivery. And whether subcontracts will be paid in arrears or not. So often they will be paid after the work's delivered. So the cash flow implication of this is important. So for all these examples, the key is to raise questions in advance of agreeing the approach and document the approach agreed. Ideally, the funding contracts or the grant agreements will stipulate all the key deliverables and the responsibilities. And obviously engaging a law firm or someone qualified or experienced is a good idea for large scale or potentially punitive contracts as well. So managing the financial risk of projects. So we'll go through this I'm just conscious of time, go through this reasonably swiftly. So assessing risk, financial risk, as with all risk, it's useful to look at it through two different lenses and assess the impact and the probability of this financial risk. So in terms of the impact of financial risk, this is about looking at what could the financial loss amount to. So what could a blowout look like, and can the organisation absorb it? So what's the worst case scenario? So for example, $1 million project that overruns by 20% looks like a $200,000 gap. How does this amount compare to your organisation's working capital or reserves, calculated as per the previous slides? And is the loss a sizable chunk of that? Could it cause major financial stress to the organisation? The second part there on the probability is how likely is this to happen? So if your organisation's experienced in budgeting for and delivering to budget on a similar kind of project in the past, a significant overrun may not be likely. You probably know the kind of work, what's involved with it, and any the potential things that could crop up, and you're likely to budget for them. The nature of the work and whether you have the experience in it is really key to understanding what this financial risk is. So also, some projects will only involve predictable or fixed costs. For example, a staff member carrying out a funded support service, quite straightforward, quite predictable. Whereas other costs, other projects might include something like a refurbishment of a premises. We all know from our own, renovation projects, that these can really throw up some unforeseen and unquoted costs. So, things like wiring, pipes needing to be replaced, all these kinds of things that can really look like a blowout. In terms of assessing these risks, another one that's quite important to understand when you have increased throughput of money through an organisation is that your risk of financial loss through fraud, it increases naturally because the impact potentially increases. While the probability may not change in terms of, your controls are in place, the likelihood of it happening might not increase just because you've got more funding or more expenditure going out the door. Your exposure to the size of the loss or the impact of that could increase. So really looking at making sure you do have those internal controls in place. One other area just to point to is risk of loss through for cybersecurity kind of through cyber risk is something that we're seeing more and more all the time. So ensuring that, with increased throughput of funding and potentially very large amounts of expenditure going out in construction type projects, that looking that you do have potentially increased controls or increased layers of sign off for those if needed, just to cover off on that risk. So in terms of mitigating financial risk and managing it, once you've assessed those areas and how badly and where things might go wrong, it's time to look at kind of some practical things that you can do. Obviously, contractual protections are ideal. So that's things like agreeing fixed price quotes, otherwise limiting contractual costs. So if you think about staffing, that's always naturally in place, that you've got a contract in place, so you're going to pay a staff member X. That's it. But where you've got something potentially that might be changeable, that's something really to look at of how can you lock down that cost or at least limit exposure. Milestone-based payments to partners and subcontractors, and so having break clauses or termination clauses also effectively in place in those agreements is really important. I think Karen mentioned that earlier as well. And budgeting really for contingencies is quite important, especially again in construction type projects where contingencies could be anywhere up to 10-20% in a fairly predictable way. That's really important to do. So sometimes a funder won't necessarily cop a contingency line in a budget. That doesn't mean that you can't somehow provide for it in your own organisation's accounts. So looking at that, maybe having that contingency line in place as an element of co-funding, or putting aside earmarked reserves or something like that in your accounts, is a way to kind of, I guess, provide for that potentially unforeseen event. But ideally, it would be factored into your costs in your funder budget. A really, really big one that we're seeing as well at the moment is needing to manage inflation risk. So because some of the funding might not be in a recurrent funding program within government, it's likely that CPI indexation may not be made available as an organic process from government. So looking at funding projects that are likely to go more than 1 year in advance, inflationary pressures obviously have been, are increasing. They're very acute in building and construction. So really building inflation into your costings and not just setting one annual budget amount, making sure that in a multi we can talk a little bit later on in our budgeting section about what those inflation figures may look like. Ensuring funding is received in advance can limit cash flow headaches as well. Okay, so one way of management of financial risk and mitigating financial risk, it really is an ongoing exercise, and that means good reporting against budget, close monitoring and internal controls over it, and we'll go through that in this section. So principles of good budgeting. Starting with gross salaries of direct personnel is usually our first kind of step. Making sure that you've got employment on costs added. So things like super, your workers' comp, all of your leave percentages, your accountant or CFO should be able to tell you what these are. They do differ slightly from organisation to organisation. Some organisations have things like enterprise agreements in place. Others have more generous leave entitlements. Everybody's workers' comp is slightly different depending on the exact sector. So you should be building those into indirect staff costs, consider including middle management, anyone who supports for leave cover, and any other staff who can be justified as contributing to the program. Directly allocating costs where possible is obviously ideal. And then ensuring that you do have your admin fee on the top there. So really putting your overhead fee or your admin fee in. Your accountant, again, should be able to tell you what that percentage needs to be. It does differ from organisation to organisation. There's not a magical percentage, but generally the magical answer is as high as possible in terms of what a funder will allow and what you can substantiate or justify as an organisation. And that's to ensure future financial sustainability as well. Really another couple of things just in this climate of really high inflation and of economic volatility at the moment is to ensure that you're getting quotes, especially for capital works, and that the quotes are recent. So we're seeing even every few months costs in and supply chain issues causing really high inflation within specific sectors. And especially in construction and building, again, and including the CPI on multi-year budgets. Just for reference, the RBA publishes CPI rates all the time. They're looking at the most recent outlook for the next couple of years is looking like 7% in the next financial year for FY23. Sorry, for the end of this financial year, and for the next one around 4%. Although really it's very, very difficult at this point to say what that 18-month kind of outlook might be. So really making sure that you're quite conservative in building in a high inflation amount at this point, because things do seem to be worsening before they're getting better, will help to make sure that your project budget stands in good stead over multi-years. And lastly, In terms of financial reporting and project reporting, really your project financials and being able to see those on a regular basis, so monthly is ideal, is really one of your key strategies on mitigating financial risk. And so that means, being able to early intervene where something's not quite right. So frequency is important. Being able to see against your project budget, so your actuals against your project budget, and having your project budget be phased is important to enable that good reporting. So looking month to month across the project at what that budget, at how that budget will play out is important to be able to integrate it into your management reporting later on. So that means that you're looking at accounts should be prepared on an accruals basis, so recognising costs incurred that haven't yet been paid. So that might be somebody's delivered you an invoice, it's not been paid yet, but it should appear in your accounts. Reports, it's important to know your project budgeting and your reporting will not necessarily show committed funds. So your month-by-month financial reports won't show commitments unless you have a purchase order system and that these are specifically developed taking your purchase orders into account. So much larger organisations may be able to track this. Certainly government tracks, their kinds of accounts on that basis, but most smaller and medium size NFPs won't have that system in place. So you'll need to kind of mentally account for those when you look at your project budgeting, your project reporting. And your reports should include those non-cash items like admin fees, and anything else like leave provisions, things like that you don't necessarily actually sign off on cash going out the door. And large variances really warrant potential reforecasting. So it's really important to monitor on an ongoing basis if variances are really getting too big and building up, then we need to have a look at probably reforecasting. And that means going back to your project budgets, rephasing them, recutting them and intervening early if things are getting, if variances are really getting much bigger. So one of the really important things to question is, am I seeing what I expected? And are the things on the ground reflecting what's happening in the program? If not, talk to your finance person. So I'll hand back to Karen with that.
Thanks, Anna. And so we'll just wrap up. I'm aware that for those of you who are watching live, that we're a little bit over time. We are looking at ways that we can also allow you to stay on and ask questions. So if you have any questions, please feel free to pop them in the chat and we'll endeavour to answer them as best we can. And noting that for all of you that we are developing a range of information sheets and tools for you to use as part of Homelessness New South Wales sector hub work. So look, just to bring it all together, really the bottom line is know thyself and know others. Look at the areas that you need to think about. So we've talked today about a whole range of areas and I've presented some questions you might like to ask on the slides, but areas that you need to be thinking about when partnering. What is your purpose? What are your values? What is their purpose? What are their values? What does your strategic plan set you up to do? Is this in line? Is it getting you there? Just because it's bringing in funds, it doesn't necessarily, it's creating the change that you're seeking to see in the world that you operate in. So really thinking about, are we in the right place at the right time? Have we got the capacity and capability? Can we deliver? And I think Anna's really highlighted that the financial and the operational questions are intersect here, and we really need to stay thinking about both. Also thinking about finance more specifically, doing that project readiness assessment, looking at the pricing structure of the project and making sure that it actually allows you to be able to deliver. And do you know how much things cost? understanding your financial position and monitoring, assessing your project financials, looking at your partner to make sure that they're able to manage as well, because your due diligence actually means that you should understand if they're actually capable of delivering on the financially, as well as in other ways on the things that they've committed to. Make sure that you look at risk. Don't be afraid to game out various scenarios and understand like how much risk your organisation is willing to tolerate. Thinking about in advance who will monitor risks and check in that they're being managed. Is that on your board agenda? Is this something that you do regularly? If not, what new tools might you need? And we've talked today about matching agreement at the right level for the type and size and scope of the project. And, you know, thinking about not only have you checked this, but are the partners that you're working with doing the work here too? Are you clear on your roles and responsibilities? Does everyone know what they're meant to deliver? What are the financial arrangements? Have they been properly stepped out in any type of agreement? And do we all understand how they're going to work? You know, Anna talked about the importance of understanding the impact of payment in arrears on your costs. So thinking about, you know, when do you get paid? How does that impact on your payroll? How does that impact on your finances overall? Small things like that can have such a major impact. Be really clear about how you're going to manage agreements. You know, do we know how decisions are made? What is the role of a lead agency versus others? What are the power dynamics inherent in agreement management? And are you comfortable with them? Have you had conversations about some of the hard stuff, not just the fun stuff of we're going to build this new fabulous project or this new fabulous piece of you know, equipment, or we're going to build a new service hub. We're going to build something that's very exciting. If push comes to shove and things don't go quite as we expect, do we know how we're going to manage that? Can we actually get the right skills to support us to do this well? And in the end, you know, have you sought the right advice? Do you have the advice you need to make a really good decision about your organisation's risk and your organisation's ability to deliver on this project, and have the people that you're working with had the similar advice? So I just want to finish up to say there's lots of resources out there. We are developing some additional resources for the Homelessness New South Wales Sector Hub, which hopefully will be out in the coming weeks. Justice Connect have some excellent website resources around legal agreements that I highly recommend that you seek out. The New South Wales Council of Social Services, their sector resources page has some really useful materials. The Institute of Company Directors, the Community Directors Australia, very cost-effective membership if you're looking for information for your board, very targeted to smaller community organisations. And of course, the Australian Institute of Company Directors, which is a very expensive membership. So I only mention that it's there. They have some excellent resources available too behind a paywall. So just to be upfront about that. Thank you so much for your time. It's been wonderful to have the opportunity to have these conversations with you. Thank you very much, Anna, for your perspective and input. It's hard to get great financial information. And I think Anna's given us a really great steer as to some of the things really practically we can do to partner for success. And I hope I've given you that bigger picture also that allows us to think through what a great partnership is, who we need to partner with, how do we make the impact we want to make, and how do we do it in a way that keeps our organisation sustainable. So thank you all very much for your attention. I think that we're going to be taking the questions now, and you can submit your questions through the Q&A for those of you who are live.